We're seeing all three major averages right now slipping about 30 minutes into trading. Now, on the back of this stronger than expected consumer confidence report, we did see just a little bit more movement here, but this is largely where we've been at over the course of the start of today's trading activity. Markets have recovered from that early August slump. Yeah, you remember that. My goodness, Mercury went into retrograde and the markets reacted. And the S&P 500 trading near highs, the Dow closing at an all-time high on Monday. So is there more room to run in this rally, in this rebound that we've seen, or should investors seek less risky opportunities? We've got Troy Gayeski, who is the Chief Market Strategist over at FS Investments. Troy, always a pleasure to speak with you and get some insights here. So do you believe that there is more room to this rally?
Yeah, I think in the ultra short term, we're continuing a recovery phase from the recent correction, which was driven by obviously tremendous yen strength and a deleveraging across markets. However, we're going into a pretty ugly seasonal period historically in September. And, valuations are a terrible indicator of short-term performance, but they tend to be a pretty good indicator of medium to long-term performance. And we were through yesterday, it's open 21 and a half times forward earnings, which is more expensive than we came into 2022 before the Fed started to tighten. So, for our clients, we're really focused on what we refer to as growth at a reasonable price, kind of an almost archaic concept for public listed equity markets these days in middle market private equity, particularly focused on the secondary market where there's a lot of selling pressure still from institutions. You can pick up pretty good discounts. And then if you're trying to get income, there's still tremendous opportunities in private credit because even though the Fed is about to cut, the new terminal rate is 3, the current base rate's 5.25, and you're still earning a healthy spread to risk-free with delevered balance sheets and tremendous opportunity in asset-based lending.
Troy, just to circle back on the Fed of it all that you mentioned here, the level of cuts that the market is pricing in right now feels commensurate with a economic downturn, right? And I'm curious, can you have your cake and eat it too? Can you anticipate 100 basis points of cuts before the end of this year and also be pricing in an equity market that's going to continue to hit new all-time highs?
Yeah, so have been coming into this year, we were in the 2 to 3 cut camp. We're now at 3. We'll more than likely get 325 basis points cut. So the market's priced in a little bit more than will probably take place. That being said, if you think of this entire Fed hiking and cutting cycle, this is one of the few times where markets are relatively aligned with reality. Remember, coming into the year, there was the prospect of 6 cuts, which was laughable. And then when we got stronger inflation data in Q2, it was like the Fed's not going to cut at all. That was laughable. Your point is accurate, though. It's tough for the Fed to thread the needle. But remember, we're in a period now where, business fixed investment is cranking, construction spending is still going strong. The consumer is not in the robust shape they were a year ago, but is still in a relatively good place. And so our expectation is for the Fed to guide or cut by 3 times next year, somewhere between 3 and 6. That should help support consumption and keep us out of a recession. However, if the Fed ends up cutting more aggressively, that basically lays out the scenario you're discussing, where we are going to enter an unexpected recession. And at that point, clearly equities will go through a meaningful dislocation. Think somewhere around 22-ish type price action or slightly worse. But that is certainly not our base case.
Troy, if Nvidia comes out and lays an egg in their earnings report this week, does that become more important and what they say become more important than what the Fed has already signaled?
Yeah, it's a great question. So, obviously the bar was super high for Nvidia going into the last several earnings. This earnings season, not quite as high. There's a lot more trepidation on AI spends going forward. Obviously, Nvidia hasn't recaptured its recent high. So from our perspective, on a technical basis, if they miss, there's less downside than, say, the last few quarters. And if they really beat again, there's more upside. Furthermore, if you parse through the data and look at the AI spends, which I don't think people recognize just how large these business fixed investment spends are for mega cap tech. They're literally 70 basis points of a $28.6 trillion nominal GDP in the US now. Really big numbers. If you look at the spending, really the mega scalers in the cloud, have decided it's better to spend too much and overspend than underspend and get left behind. And so naturally, the beneficiary of that are semiconductor companies, which continue to have forward demand growth and free cash flow margins at market caps the like we've never really seen in the history of public listed markets. So to short answer to the question, if they miss, less downside than the prior 2 quarters, and if they beat, arguably more upside, not only there to that individual company, but to the broader tech sector.
Is Nvidia unsellable right now, Troy?
I think saying unsellable gets back to what your personal positioning is in terms of your portfolio. Obviously, one would be foolish to expect the same degree of market cap growth that we've seen in the last 18 months. But if you think of where you go for growth in markets, right, there's really 3 choices right now. There's middle market private equity right in the middle of the risk reward. There's venture capital, but those are very long cycles and obviously super volatile, and you have to lock up your money for a really long time. And then there's mega cap tech in the US or publicly traded market cap weighted indices. The problem there is not the fundamentals. The fundamentals are solid. It's the valuation. So you have to recognize that given the elevated valuations, you're going to have less upside. But it's going to be very hard for any active manager to sell down further after a lot of that exposure had been reduced the last 2 to 6 weeks, not only in the long-only community, but also in the hedge fund community. So it would probably be unwise if you're a long-only active manager to sell down Nvidia right now.
Troy, I can tell you're really fired up about middle market private equity. Why is that, and what is the entry point for investors that even want to kick the tires on middle market private equity?
Yeah, so there's still constraints, regulatory constraints. In some cases, you have to be a accredited investor. In some cases, qualified client. If you're doing any type of drawdown structure, you still have to be a qualified purchaser. However, the industry's democratized those strategies. It's really the last frontier of democratization of alternatives, bringing private equity through evergreen RIC structures. So there are limitations. However, the reason we're so fired up is if you look at PE historically, the way middle market's driven return is through organic growth, through growth at a reasonable price, where you haven't necessarily needed a zero interest rate policy environment to lever up the balance sheet. You've benefited from, but you haven't needed the multiple expansion we got from 2009 through even today. So with the expectation of a stronger for longer economic environment, a higher for longer interest rate environment, growing EBITDA at 15% plus is a reasonable expectation. And this whole concept of growth at a reasonable price, it's very hard to find across markets. You can find growth at either unreasonable prices or at least extremely expensive prices. You can find goofy value and other cyclical exposures, but it's really hard to find growth at a reasonable price. And then on top of that, you have this tremendous secondary opportunity because institutions got over allocated to private equity and still are, and in some cases are choosing to sell down those exposures at significant discounts. So that kind of creates a near-term performance pop, which provides new investors a good entry point to first participate in the asset class.
Yeah, entry points are ever more attractive in the high valuation market we're in right now, Troy. Thank you so much for joining us.
Great
really
to see
appreciate
you.
your time as always. That was Troy Gayeski, Chief Market Strategist over at FS Investments.